We start off with stocks snapping back, the Dow soaring about 350 points at the highs of the day after yesterday's steep sell-off. This all after President Trump said the trade war is really just a little squabble. Tech, the best performer, leading the charge back, but the market closing well off those highs, ending the day up about 200 points. So, can you trust this bounce, or is there more pain ahead, Guy?
No and yes. I answered your questions correctly.
Back to me.
No, you can't trust the bounce. And yes, I do think there's more pain. So when I say more pain, I'll say it again. I said it last night. I think the S&P can absolutely trade down to 2650. That's, I don't know, 180 or so S&P handles from here. I guess that's 6.5%. And I think that move is definitely in the cards. I think you have a major double top in terms of 2940. President Trump can say whatever he wants about it being a squabble, easy to fix. I'm not certain that's the case. I think he understands that as well. I understand that he wants the stock market to go higher, and he had that happen today. But I still think now his tweets are diminishing marginal returns. I think the market goes lower from here.
Where are we in terms of levels?
We're in no man's land, right? We were 2,900 on Friday. We reversed off of it. We were 2,800 yesterday, reversed off that. We failed at the 50-day today. The internals were very tepid today. Advancing stocks only beat declining stocks by about 3-1. On good rallies, you want to see that 5-1, 6-1, 7-1. Trend was like 0.7. You want to see that near 0.5. So I was a little underwhelmed with the response today. I was underwhelmed with the leadership. I think it's early. We're 1 week into this pullback after a 4-month move. We pause here.
Well, there's no reason why the response should have been emphatic. And to be clear, a couple, somewhat vague tweets are not even making up for some very defined and I would say pronounced tweets that came from the White House. And then some press over the weekend in China that let it be known that China's ready to dig in. So you went from, we talked about, let's take semis. Semis rallied back 2.5%. Some people on any other day would say, wow, emphatic, except for the fact that the semis were, if you talk about a relative strength indicator, which we occasionally do when the market warrants it, how oversold were they? Well, 19 RSI on a 9-day basis was near where we were on Christmas Eve. Everybody remembers Christmas Eve. Guess what? After today's move, the RSI is now back at 35, which means it's not oversold. And so you can get from oversold to not so oversold pretty quickly, which sets you up for getting to oversold again. I'm not saying that we have to do that, but I guess this is some echoing of the same sentiment. So if the trade deal goes poorly, the Fed is definitely on the side. The Fed's on the sidelines now. But if the trade deal goes poorly, the Fed might cut. Yes or no?
Well, yes. Fed funds futures already at 53% for September.
They're more likely to cut if it goes south, the trade deal. If it gets better, the market's more likely to go higher. So I think you're sort of in that sweet spot, if you will, after all the sell-off that we've seen in the overall market. So I am constructive, although I do like Guy's level of 2650. That's interesting, because you've been pretty bearish. And now you're getting constructive when things look pretty awful. Yeah, and I think that everyone thinks there's not a reason why the market can go higher. Just think about it. We're not going to hear any new news about trade for the next couple of weeks, right? So you're not going to hear any new earnings the next couple of weeks. What did we all grow up in the marketplace? Never short a dull market.
Dull market.
So you have a couple of reasons. So I think we can sell off, but how long will that sell? I think it'll be quick. It might be, deep. It might feel terrible, but I think we snap right back.
Well, when you look at some of these levels, 2750 would be giving back a third of a 25% rally. 2650 would be giving back about half. Those are reasonable corrections after 25% moves. What I didn't like about some of the macro parts of today's move, copper was soft, oil reversed off the highs, bond yields were up a basis point.
Bond yields were strong
and bouncing. And,
I wouldn't say the macro narrative changed at all with today's move.
Today was just you said it. We were oversold. It was a whiplash back. I don't think anything was resolved on a day like today, although it does get you, if you are bearish, back on your heels, because you have a perfect storm here. This is a perfect storm for why the sell-off should hold, but there's too much nice talk on trade. There's not enough. Take out the tweets from President Trump. There's not a lot that makes me say, "Oh my gosh, this is irreconcilable. This is not irreconcilable. It's not going to happen."
In terms of the markets today, I mean, taking a look at the areas of weakness, Chris, you had mentioned too, and I was definitely noticing the bond markets, even from this morning in the pre-market trade when futures were higher, bond yields weren't really moving too much. But during the session, Facebook closed lower. We were noting that Alphabet finished lower by 1%. FedEx closed lower. I mean, there's certain stocks in the market you think, if this is going to be a rally broad-based, these stocks should theoretically be higher.
So quickly, on a day when the market's up a couple hundred Dow points, Google, given the sell-off it's had, I mean, that's a stock that probably should have had a relief rally today. And quite frankly, it didn't trade well all day. Facebook as well. I mean, I think you make a great point. So I thought the rally today was less than inspiring, to echo what Mr. Verrone is saying. I'll say this as well. I think today was probably, if you're bearish, I think today was the exact day you wanted in terms of.
Facebook had privacy issues on its own.
There were some idiosyncratic.
Google, you could lump in there. If privacy is going to be a problem, then you could lump in Google.
And if we add some names to that list and put this market in context of bellwethers, names like AMAT, names like JPM, names like Caterpillar, I think that's going to tell the tale of the tape here as we move over the next couple of weeks. But I would stop short of calling this market yesterday oversold. I mean, we're 4% down over a week. And I recognize some of the short-term tactical stuff was, but you still had 40% of stocks above their 50-day moving average. That's not deeply oversold in the context of a 4-month rally.
It's going to come down to what people are willing to pay for the S&P at this point. And so this is the issue. I think this is the biggest and the most relevant debate, because interest rates, to me, I think we see 220 before we see 280 on the 10-year. Okay, I think if anything, we have a lot of uncertainty still. We've been here before for markets where people have been willing to spend not just 17, which would take you to around 2,900. 17 times kind of current estimates, which is around 170, although we're seeing some downgrades. But you could also see the market wanting to pay 18, 19. We've been there when rates are zero. All of the things being equal, I think you have a dynamic where stocks don't have to sell off a lot. I think the volatility of the trade war is still the uncertainty that hangs over this market.
I mean, there's a note this morning out from J.P. Morgan about Apple, what Apple would have to do in order to maintain current gross margins. Apple would have to raise prices
14%.
by 14% on its iPhones in order to maintain gross margins. For retailers, they would have to, on average, according to Bank of America, raise prices on apparel by 2.3% in order to preserve their margins. People still don't know how exactly companies are going to deal with this, whether they can absorb those costs, which Apple ultimately may be able to do. But can retailers, for instance, with such thin profit margins, we don't know a lot of things, a lot of answers.
Quickly, I understand what Steve is saying, and my pushback would be, you're talking about an inflationary environment on the back of these, whatever you want to call it, trade wars, trade dispute. I mean, if inflation picks up on the back of this over the next couple of months, I mean, the Fed finds themselves in a very difficult position. We brought that up last night. So, again, I'm no fan of the Fed, but if inflation is their mandate, and if we're going to have an inflationary environment based on what exactly you just said, they're going to have themselves, they're going to be quite a problem.
Yeah, I mean, I find that transitory will sneak back in. If they do get any whiff or sniff of inflation, they'll say it's a transitory event based on trade wars. They won't dictate policy or have another policy mishap. And that's what it was. Trade wars, the sell-offs that we get on trade wars, they've been short. The sell-offs that we get on Fed, those have been longer in duration.
I just, we're going to have a nice discussion on Walmart and Amazon later in the show. Yeah. I'll just say this, though, about big box and in general. The labor cost pressures and the competitive environment that is cutthroat amongst all of those names that we know sit in the same kind of saddle with Amazon, with Walmart, which don't include Amazon. I think you've got a big problems there for retailers in terms of margin pressure and whether they can make money. And I think that's an issue right now because they can't pass it along. What apparel company can be passing along? Unless you're Nike, you go into stores to buy clothes, they're going down, Guy Adami, so you should think about that.
And Tim, the staples have been telling us this for years. If you look at all the consumer staples, they've been sending this message for years. It's only the discretionary names that might be finally catching up to this.